Hi everyone, welcome back to your classroom. I'm Thatcher Taylor, owner of ProPath Financial and certified financial planner. When I help retirees plan for retirement, one thing we have to account for is you having too much income so your Social Security becomes taxable. And not to get rah-rah political, but Trump has said that he may cut the taxation of Social Security benefits when you receive them.
I'm promising no tax.
We're going to have no tax.
No tax.
And no taxes.
No tax on seniors' Social Security.
Whether he does or doesn't, we don't know yet, but I'm gonna tell you how your benefits are taxed right now. And first, before we continue, I wanna say thank you for everyone that has supported the channel. Please make sure to like and subscribe and comment with any questions below. I can't wait to hear from you. Federal income taxes tend to be fairly straightforward in your retirement years, especially since when you were working, most of your income came from a regular paycheck. However, once you enter retirement, things can get more complex. The complexity arises because retirees can sometimes draw income from multiple sources. And one of the biggest income sources in retirement are Social Security benefits. So just in case someone hasn't told you, if you have too much income, that brings some of your Social Security, actually potentially a lot of Social Security, up to 85% of your Social Security benefit onto your tax return to be taxed. How much of that Social Security benefit is taxable depends on your overall income. They use a very specific calculation called provisional income or your combined income. I use provisional income. This figure is calculated by taking your adjusted gross income, adding back in any tax-exempt interest, and then adding half of your Social Security benefit onto that. So adjusted gross income, tax-free interest, and one half of your Social Security income is your provisional income. This number is very important for the calculation of how much your Social Security will be taxed. There are bands within this depending on how much income. So let me read them to you. For single filers with combined income between $25,000 and $34,000, up to 50% of their Social Security benefits may be taxed. For those with a combined income above $34,000, up to 85% of the benefits will be taxed. For married couples filing jointly, the thresholds change, they're a little bit higher. No benefits are taxable up to $32,000 of provisional or combined income. Between $32,000 and $44,000 or 50%, and above $44,000 up to 85% of that income is subject to tax. In some cases, individual in the 22% tax bracket might find that a small increase in retirement income leads to a much larger jump in the taxable portion of their Social Security benefits. This effect can push their marginal tax rate up to about 40.7%. This is called the Social Security tax trap. If additional income causes your Social Security benefits to become taxable, that extra tax that you pay could far exceed the simple 22% rate you might expect to pay based off your AGI. Then you take your standard deduction or itemized deduction, and then that's your taxable income. To illustrate this, let's imagine a couple, they make $72,000 in Social Security income. On top of that, they get another $70,000 of IRA distributions. I don't see too often because it really depends on the state if they have good munis. I very rarely see additional tax-free income. California is pretty good for munis, but in general, it's usually Social Security and then income sources like pensions, IRA distributions, capital gains income, or other income sources, maybe some earned income. But let's say you just have $70,000 of additional IRA distributions. Their combined or provisional income at that point would be $106,000. $70,000 plus $76,000. At this level, not all of their Social Security benefits are taxable. Because remember those bands that I mentioned before? Their combined income is $106,000. So between $32,000 and $44,000, it's 50%. So that's $6,000 because 44 minus 32 is 12,000. So you take 50% of that, and that's $6,000. Then anything above the $44,000 range is going to be subject to 85%. So the maximum amount of Social Security that could be taxed for them is $61,200. That's 85% of their total Social Security benefit for the year. And so if we went, let me do this calculation with you. If we went $106,000 of provisional income, we subtracted $44,000, that's the top end of the band, that equals $62,000. So if you take $62,000 times 0.85, that equals $52,700. Plus the additional $6,000 between the first band that we already calculated is $58,700. So $58,700 goes on their tax return as additional income, which is really, really interesting in their tax situation. So at this level, not all their Social Security benefits are taxable, yet if they were to pull an extra $1,000 from an IRA, you might initially assume if they're in the 22% tax bracket, that'd only be $220. In reality, because that extra $1,000 causes $850 or 85% more of their Social Security benefits to become taxable, their tax bill could increase by as much as $407, effectively raising their marginal rate to 40.7%. At higher income levels, this eventually tapers off, but in that range, when you're right on the fringe of those tax brackets and the additional income from like an IRA distribution, you're really going to be taxed at a higher level. Let's end this with a couple planning opportunities. Since required minimum distributions from retirement accounts can push that amount higher like we just discussed, trying to reduce money in IRA accounts could really be valuable to reduce down those required minimum distributions. This would take some planning, so you'd have to get to work on it now, doing some things like Roth conversions. In addition, in retirement, you have some years where you need more income than others. So trying to plan for that, where you can utilize some dollars that are not IRA dollars to help fund expenses, could be a really valuable tool to keep those distributions down. Things like using cash reserves, using taxable brokerage accounts with investments that have a higher basis could be very valuable tools in your income distribution strategy. Another thing is delaying Social Security benefits. When it comes to timing, if you're taking your benefit early at 62, you're exposed to this right away. And say you're taking your benefit early because you want it now and you're still working, all those benefits, whenever you start taking them, are going to be pulled in to your Social Security income. I should say all your benefits, up to 85% of your benefits. So not only does waiting maximize your benefit, it gives you a little bit more time to plan and prepare. So maybe waiting to take your Social Security could be better for you. With careful planning and maybe some personalized advice, we could avoid a lot of this extra taxation that is unnecessary. But you got to start now. So if you need some help and you haven't thought about this, where your money's going to come from, how much you need, how you're going to navigate Social Security, contact me below. I specialize in navigating this scenario for you. Thanks for watching. Hope to see you next time.